This is Rachel, and today I want to share a little bit of my personal experience with you, as my husband Lucas and I just went through the purchase of a home a few months ago, and while there's a lot of personal decisions surrounding where you want to live and what you want that house to say about you and how the space will be laid out for your family needs, there's a lot that goes into buying a house. I want to really hone in on the financial considerations that you're thinking through in terms of purchasing a home and paying off that home. So when you look at your financial goals, typically they have to do with maintaining control of your capital, increasing your cash flow, and also paying off debt as quickly and efficiently and safely as possible. And those three goals sometimes seem like they're in conflict, that if you maintain control of your capital, that you'll decrease your cash flow. Or if you keep your capital, you're not going to be able to pay off debt. Or if you pay off debt, you lose your capital. So I want to look at three keys that I really feel are critical in helping us understand how to do all three: maintain our capital, increase cash flow, and also pay off debt as efficiently and quickly as possible. So the first key is that we need to understand the difference between being in debt and having debt. Now, as simply as I can share this, you have assets and you have liabilities. An accountant would say this is your balance sheet. Your assets are things that you own. These are things that you own that have physical value. This is the value of your home, the value of your cash in your accounts, the value of your automobiles. You also have liabilities. Now, these are things that you owe. You have an obligation to pay this. This is the balance of your mortgage, the balance of your student loans, credit card debt. This is car loans, any other kind of debt obligation. Now, when you look at a simple calculation, assets minus liabilities equals net worth. So when you talk about your net worth, if it's a positive number, that means that you have more in assets than you have in liabilities. Now, that is also called an equity position. If it was just a house, we're talking about a house only, and say the value of the house is $200,000, and you currently owe $100,000 on that property. You own more than you owe by $100,000, and so you're in an equity position. The same is true with your full financial picture. So all of your assets minus all of your liabilities is your equity or your net worth. Now, when that number is negative, if you were to say you add up all of your loan and debt obligations and that number was actually higher than the assets that you have, now that's a true debt position. This is a position where you have negative equity. This is when you owe more on your house than it's worth and you're underwater. Or when you have more in student loans and credit card debt and your mortgage loan than you have in tangible assets that have a value. So when somebody says, I want to get out of debt, often they're referring to they have debt. They may not necessarily be in debt. And so we want to differentiate the two and think of this in terms of a cash flow perspective. So the second piece is understanding what your money could be earning for you. Now, of course, for the person who's a knowledgeable and sophisticated investor and knows exactly what stocks they're going to invest in and knows that they will probably produce 8% return, that person knows that their returns are about 8% when they invest in their area of expertise in what they know and control. Now, a real estate investor who's skillful and has mastered real estate investing and they're working in a particular market that they know very well, maybe their return is, 20%. Let's just throw a number, 20%. Now, if that is the return that you know that you can get with investing in your area of expertise, that is the benchmark then for what you want your money to be doing for you, and really nothing less. So now when we compare that over to what equity in your house can do, we look at the overall appreciation of your home in terms of the real estate value. If you expect the market to continue to go up, it's possible you could be returning a 2, 3, 4% return in your house. The question is then, is that a good place to invest your money, or should you be putting it in something that you know you can get a higher return? That's called the spread. Now, the only way you will have an idea of how much you can return is by honing and developing your investor identity and your skill in investing in what you know and control, in increasing your knowledge. The third thing we want to look at is increasing your confidence. So every current financial decision you make is with the goal of increasing your future confidence. If it doesn't increase future confidence, it's probably not a good idea. So when we look at this in a big picture perspective, being in a position where you have capital set aside, savings that you know you can access in an emergency, or if you completely lost your income for a span of time, that creates confidence because now you know that there's nothing that can take out that rug from underneath your feet. When you're in a position of saying, would I have more confidence with a fully paid off asset or more confidence with savings in the bank? What do you think? If savings in the bank has the ability to produce the return if you use that savings to invest, say a 20% return, that could be the more effective use of your money rather than putting it into your house and earning a 2% return if the market is favorable. When we look at this overall, we realize in the purchasing decisions for a house, you're first looking at a larger down payment is going to deplete your capital. So your savings that you've built up, it's going to deplete those reserves. But the more you put down, the smaller monthly payments you'll have, meaning that a greater down payment is going to give up your savings that you currently have that you probably could produce something better somewhere else, but it will lower your expenses on a monthly basis, meaning that you have more surplus left over. That's more cash flow on a monthly basis, which then you could be directing back into savings or investing somewhere that you know and control. The other piece, besides just looking at how much to put down, is saying how long of a term do I want to be paying over this loan? The longer loan is going to have more interest payments, but it also will have a lower monthly cost. So if you're looking to increase your cash flow on a monthly basis, two ways to do that. Have a higher down payment or have a longer monthly term. If you want to maintain your capital and be in a position to also increase your cash flow as much as possible, the lowest monthly payment and the longest term combined together is often the most effective way to maintain control of your capital, increase your cash flow, and then what about the paying off the debt as quickly as possible? What we want to think about then is when you're in a position that you could pay off the loan, regardless of whether it is paid or not, that is considered an out-of-debt position. You now own more than you owe. Your own contains and includes not only the value of your home, but also your cash accounts. So if you, say for instance, had the opportunity to have $1,000 per month allocated between saving or paying off a home, and you said, I'm going to save $500 and I'm going to put into my home, pay a monthly payment of $500. I'm just using simple numbers. I know this is not fully realistic with the housing market today, but if you said 500 is going into savings, 500 is going into my home, that's the smallest payment that I can have. What you're in a position of saying now is you're building up $500 a month over here in terms of savings. And when that savings balance is large enough for you to be able to say, I could pay off this loan fully, dump my savings, pay off the loan, you're now out of debt. You still may have debt, but you're out of debt. You're out of a debt position. And that creates greater confidence because now you're in a position where you say, well, if I lost my income, I still have the ability to make my housing payments. So my question to you is this: would you feel more confident and more secure with a fully paid off asset and no savings, or an asset that has a longer span of monthly expense that you're continuing to pay and a gigantic savings account? And that's the question that you need to ask yourself. So the action steps you can take away from this really would be to say, add up your assets, add up your liabilities, figure out the calculation, assets minus liabilities. Where do you stand? Where's your net worth today? Are you in an equity position or are you in a debt position? Once you look at that, we want to say, How do we put as much cash flow as possible, as much buffer between our income and our expenses, so we have that money directed over to savings? Because remember, cash is king, and having a gigantic amount of savings is going to do a lot more for you than saying you have a paid off asset and no money. Thanks so much. Have a great day. I'll see you next time. Hi, this is Rachel. I hope you enjoyed this episode of Money Secrets. If you did, like this video, subscribe to our channel, and leave a comment below. I would like to invite you to get your free cash flow generator to help you start keeping more of your money. Come on over to marshallsinsurance.com/cashflowgenerator to sign up.